All right. Hey, everybody. I'm Julian. I help run the demandcurve.com marketing training program. And I also write TechCrunch's marketing column, and I used to run marketing at a company called Webflow. So I'm here with Gustaf Alströmer, a partner at YC, and the man that I personally ask for growth help. He's the person I go to because we went through YC ourselves. And formerly, Gustaf helped run growth at Airbnb plus Voxer. And at YC, he focuses on many things, including being the resident growth advisor, like I mentioned. And what's interesting about this webinar is between Gustaf and myself, we've helped hundreds of startups think through growth. And so that's our goal with you guys today. So specifically, in this webinar, Gustaf is going to be answering your live incoming questions, which I'll talk about in a moment. And then I'll chime in and play backup with any advice that I can where relevant. Let's kick it off with one of your questions, whenever you're ready.
Sure. Thanks, Gustaf, for doing this. Let's start off with a high-level question. What are the most important metrics for growth and the most underrated metrics, in your opinion?
So I think the most important metric for growth, and by growth I mean the entirety growth of a company, is repeat purchase, repeat use, or something around retention. So it doesn't really matter how great you are at top of the funnel if you're not getting people to come back and buy or use your product a second time. So that's usually the thing I dive into first. And it's also the thing that is harder to get right. And it's somehow the thing that, because it has a bit of delay, is not something that people initially spend too much time on. I think that repeat purchase is the best indicator metrics wise of what is a great product. And there are many different ways you want to understand how people do that repeat use, repeat purchase. There's kind of like one category of them is going to be prompted, where you are sending them a push notification, an email, or maybe it's a subscription. And the other one is going to be people that voluntarily come back and buy again. You want to get into the nuances of that on the repeat purchase. For the most underrated metric, it's so hard to say. I need to think about that, I think, for a second. But I think, to not be confused, the most important thing that everyone should understand is try to understand what is the expected repeat purchase rate, what is my repeat purchase rate or repeat use rate for my product, and sort of like, how does that look over time?
And I'll jump in with one interesting tidbit, which is sometimes people ask me, hey, I'm seeing pretty good cost per action on people indicating they're interested in buying my product. So maybe they're just doing demo requests, or maybe they're getting email subscriptions or trial requests. And one thing I want to really point out is there's oftentimes an ocean between people expressing interest and then actually putting money down for your product. So I often try to make sure people don't over-index on those early indicators and just try to ask for money right away if they've already have something to sell. All right, Gustaf, next question comes from Matt Sherman. He says, Credit Karma and Mint built billion-dollar companies off of affiliate links. Why don't we see the affiliate revenue model more common in the last half decade of startups?
I think my bias towards affiliate-based business models is that they kind of are the worst of two things. So they are close to the transaction, but they don't really get a huge amount of revenue. It's almost like you have already aggregated the intent, but you don't offer the product yourself. So to me, the long-term plan of anyone who's able to aggregate the kind of intent on your product that would allow you to sell that product should eventually probably sell that product. If you don't do that, then the business you're in isn't just aggregating intent and then having the worst business model to monetize it. This might be a good idea for something like Google. And like, if you look at something like Google Flights, for example, it's like, yep, it's not really, like Google shouldn't build their own air fleet or sort of like build their own airline. But they probably should be selling tickets for airlines, and they already are, because they are all travel queries pretty much start on Google anyway. Now, if you are another website that don't have sort of the natural repeat return rate as Google have, then you're going to have to acquire those users at the top of the funnels in some way. And typically that's like either SEO or SEM or something else that is focused on rare occurrences, like buying airplane tickets is not something you do super often. When you do that, you want to have the highest possible take rate, and having just an affiliate fee isn't high enough. It's almost like you would want to do the entire transaction. Otherwise, you're probably not going to win. So I think a good example here is to compare Booking.com with TripAdvisor. TripAdvisor started off as an affiliate company where they were basically getting paid affiliate fees for hotel bookings that they were referring, which is a much lower fee because they were referring it to other hotel OTAs, like a Booking.com. That's a much smaller percentage of the fee than if you actually facilitated the booking yourself, which is what Booking.com did. And Booking.com themselves charge a much higher fee. So in that sense, sort of like you should stay as close to the money as possible. Let's see what else. So that's sort of like my primary hesitation of going after the affiliate model, is that it's just not a good enough model if you've aggregated that much demand or that much intent. And the people that have the ultimate intent, there's the ultimate affiliate marketing company, is Google. But most companies are not in a situation where they have that amount of free intent coming to your product on a regular basis, which means they should probably go into something that has higher value if they can aggregate the intent. I don't know, the kind of a high level way to answer the question.
No, I think go ahead.
The other big issue with affiliate programs is that do attract fraud. So I've worked on the Airbnb affiliate program, and that was filled with fraud at some point. So I would be hesitant on, like, there's a lot of incentive there, a little bit weird. So just watch out for that.
And I'll actually answer the flip side of the question. Matt, this wasn't your question, but I'll answer it from the perspective of, should you use affiliate programs as an acquisition channel for your own company? So a couple thoughts there. So we've toyed with this at Demand Curve and others. On one hand, it could be very high leverage. All you're saying is like, hey, you're not doing a lot of work. You're saying you have a standalone page on your website attracting people to send you referrals, and in exchange, you'll track them and give them payouts, and you don't have to do anything, and boom, there's more customers on paper, right? However, what happens a lot in practice is people treat affiliate arrangements and relationships a lot like biz dev, and they go down this very time-consuming rabbit hole where they try convincing a whole bunch of websites and people and influencers to send them leads, and it's usually lower ROI and even lower leverage, and doesn't scale as well as many other channels, like just straight up normal paid influencer or paid acquisition, content marketing, and so forth. And I can't think of many companies that I've worked with in the last 3 years that actually grew off of affiliates as a channel. All right, next question. This is a really interesting question by Phil. Phil asks, have you seen any good creative examples of products that onboard multiple users together? So I'm thinking of products like Slack that only deliver value when the user has connections. And Gustaf, before you answer, this might be an interesting little pitch for Tandem, which I think YC invested in, if that's at all relevant, but I'll throw it to you for an answer.
Great question. So I think the product I'm not super familiar with, but I know is good at this, is Pinduoduo in China, which is the social commerce app, which is now a multi-$10 billion company. We've seen many companies apply to YC with variations of that idea, but almost everyone is calling themselves Pinduoduo for something else or for some other country. That might be the best example consumer-wise. I don't think that we've seen in the commerce side a lot of similar things in the US recently. On the sort of the work style applications, I think you want to think about this from the point of view is, what is my affiliation with the person that I'm onboarding together with? And you want to figure out the strongest possible affiliation. And I think Tandem, as an example, is work affiliation. Is like, basically, this is only going to work if I'm onboarding this this together with my coworkers. And then there's a natural way that you would want to do that. On the consumer side, I think often this affiliation isn't that strong. Maybe you want to go into the gaming world or something like that to see good onboarding. We have multiple people, but I think it's easier to do it in a corporate kind of like sort of like work. If the affiliation is my coworkers, I can think of many examples of great products where the onboarding flow, all it's trying to do is trying to figure out who my closest coworkers are. They're going to activate me when to use this product. I think Slack is a good example. Tandem is a good example. Basically, the goal of those onboarding flow, typically the way they work is they do a Google Auth. They get your coworkers list. You select who are the closest coworkers through that, or the people that are already using the product that have auth with Google for your company. And then that's how you find your coworkers, and that's how you get activated. Very much like when you sign up for Facebook, you're connecting your address book. In this case, you're connecting your Google Apps account, and then authing and finding your coworkers that way. That's sort of the best way that I would build that flow, I think, because typically, and I've seen that in the past, majority of US businesses are now using Google Apps. And because they're using on their own domain, you can get access to that address book like through those APIs very easily, and you don't have to rebuild it. And most of the onboarding flows there involves other people. The key component, in my experience, is to have a very, very low friction way of showing you who your coworkers are. So I think that's why I would use Google OAuth or Google Apps to build that flow. And then I would think really hardly about what are the repeat use cases that I do on a daily basis through my work. That would be the thing that would motivate me to actually add my coworkers, because it can't be rare things. It has to be things that I do with them on a regular basis.
And part of the way I think about this is the most effective way to get someone you're inviting into your app, like a colleague or a friend or a family member, to actually take the invite seriously is to prompt them with something that they need from you, as opposed to trying to just send them a generic invite saying, hey, cool, check this out. I'm on LinkedIn now. You should join too and be a contact. Like, who cares if I'm your contact? But in the case of PayPal, when you're paying someone $10, they need that $10 from you, or Venmo. Venmo will send you an email, PayPal will send you an email and say, hey, make your account to claim that $10. Same thing with Dropbox, where
I think this is the classical description of this in the growth world was social action. It's like the best way to onboard someone that you know is to introduce a social action between the two of you. I am asking you for something, I'm giving you something, I'm introducing you to something, but it needs to be something that's a meaningful social action. It can't just be check this out or something like that.
Exactly. And a really beautiful way to make it almost seamless is interject your app in between something the business was already doing. If they were already going to make payments, if they were already going to share you files on Dropbox, you had to get that presentation from a coworker, well, then maybe they'll just share it using Dropbox, and bam, now you're on the platform as the recipient. So if you can design your product to be something that is not necessarily a brand new experimental thing people are trying out, but it's part of a flow they already have, it should make it a lot easier for people to accept those invites. And to make it action-oriented, like Gustaf says. Okay, Matt Sherman, anonymous person says, I work for a company that follows a fairly standard sales and marketing model, and they're not really thinking of it from a growth framework. What's your advice for switching us towards a model and helping that happen from a top-down leadership perspective so people think of marketing as growth?
Great question. I do agree that these things start top down, and it is challenging to be a growth person on a team where the leadership of that company does not appreciate growth. Like I don't think that you can just sort of like do it well whilst being ignored. I think you do need the buy-in, because there will be situations where there are decisions that have to be made by the leadership team of that company that will sort of like take you in one or the other direction. So a great example of that might be, should there be engineers working on growth? And to me, the clear answer is always like, of course. But that's not always that people would understand that if you don't have the background of understanding how product growth, for example, would work. The other thing I have seen in this scenario is that the people on marketing have sort of like a combination of reactions. One is that they feel threatened by the world of growth, but they feel threatened by sort of like how much software is changing growth, how the level of automation is sort of like taking away some of the tasks that people in marketing were previously doing. At the same time, the truth is that there isn't really a choice here. So if you are building your team in a traditional marketing way where most things are manual and people are using sort of like manual tools to do these things, and they're not really involving your product and engineering team, then those things are bound to not be as successful as if you involve product and engineering. So the simple answer is you have to go top down. The best way that I would do it is I would start by just presenting metrics and just start sending out metrics to the rest of the company and say, hey, here are the things that we are tracking in our team, and this is what the thing that we're working on are. And then as those metrics goes up, either you try to associate them with the work that you've done, or there's some kind of correlation, or you actually run some proper experiments. But just like starting to educate the companies on the metrics that matters, that's usually something like you want the leadership to be thinking that this is the metrics that we're going to track. And then once you have everyone thinking about that metric, like, you know how to typically push that metric using the growth skills that you've learned. I think that's the sort of like the easiest way that I would do it. But it needs to start top down, and it is challenging to sort of like change the thinking of people at the top if they're not currently sort of like that interested in using metrics to track things. But it depends on what stage of the company is in as well. Like in the earliest stage, there's much more focus on product development and product market fit. In the later stage, there's much more focus on optimizations.
Yeah, I agree. And I found a couple interesting ways to get your company to take growth a bit more seriously. One is a sort of Deus ex machina approach of bring someone in, perhaps like I don't actually do this as a service or anything, but theoretically like myself, to do an audit of your company's growth methodology and frameworks and the way you guys prioritize marketing projects, and have me just poo-poo all over your guys' very haphazard, unprioritized process, and have me sort of impassionately explain to your team why you're doing it wrong and how companies that are growing quickly with an emphasis on proper growth models are doing it. And sometimes that sort of outside third party, like wake up call can help. I've seen that a lot. This is in effect what I've been doing when I do calls with, when I used to do sales calls for Demand Curve. They're like, oh, wow, right, we're not doing this right. Another thing is sort of like Gustaf was alluding to, if you could implement growth practices and both growth best practices in your own marketing work as is, or engineering work, and just put a little report together and show them like, hey, I ran an A/B test, or I split test these two approaches, or I started with an MVP of this feature, and look at the benefit of this. Look how much time we saved, look how much money we saved, and just walk them through that, and perhaps they'll come around. Gustaf, I got to mention, we're getting the best questions I think we've ever had in a webinar. So, and we're getting a lot, so this is going to be good. Raphael says, first of all, he says, thank you for taking the time. Our pleasure. He says he has an app that requires a lot of trust from its users because they need to forward their phone calls to his app servers. It's like an AI secretary that helps answer and filter calls for you. And so Raphael asks, do you have recommendations on how to approach building trust in a new startup without a lot of social proof?
Yes. So I think there's a couple of different things here. So in my experience, the first thing is people often think that end users are less likely to do things than they actually are. So often when people say, oh, I can't, like users would never do that, they would never trust us, or they would never do that. Usually people are overreacting. So users are, in my experience, a lot more likely to try new things than you think. When it comes to building trust, there's a couple different things. One of them, the best historical example is that the thing that requires the most amount of trust, specifically in the physical world, the Ubers, the Airbnbs of the world, have relied a lot on word of mouth and referrals as growth, because people tend to trust the people that they know for using new services. And sometimes, and I always describe this, referrals works the best for products that require someone to introduce you to the product of someone that you know. So it just like happens to be that the things that requires the most amount of physical trust are actually growing very much through friends and the social graph. And it's not really happening through Facebook or Facebook app. It's happening organically in like a physical world, or people showing you the app, or you're experiencing that app together with someone else, or something like that. Online, in order to build trust, it's sort of similar in that you need to, like, I'll give you the sort of like the top-down simplest example. The first thing people want to understand is who's behind this product. So many YC companies sometimes forget to put an About Us page with the photos of the founders and the address to the founders, or to the office. And I'm like, that's where people are going to look if they want to figure out who's behind this company. You can't just not have that. So put a person behind the company, put like some other associations of trust. And like, from my experience from Airbnb, people are far more likely to trust the face of someone than they are to trust like a badge of some sort of like trust organizations that you might have not heard of. So building like the story behind who's behind this company is actually pretty important for the trust building. After that, I would say there is some level of trust built into reviews and ratings. And like a good example here is the App Store. Like, yes, people are likely to trust apps that have 5-star reviews or 4.5-star reviews, even though they kind of have an awareness that most of the review systems are sort of rigged in some way. Even the App Store review system is sort of rigged. People still have an association that having 5-star reviews is important. When you're implementing reviews, and we spend a lot of time on this at Airbnb, there are aspects of reviews that creates trust. So when was this review given? What's the time stamp for the review? What's the location of this review? Is the photo and the person's name, does those feel real? And so like, can I give a review myself? Like, do I have a trust in this system of giving reviews? But they tend to be pretty important. And then finally, I would say, in order to ask for something that has privacy implications, the first thing you should do before you ask for it is to explain what's the value of doing this. So you wouldn't ask for your access to your contact book without saying what you're going to do with it. And it's more important to say what you're going to do with it than to say sort of like what the exact encryption standard are for how you store it, if you're storing it, because people tend to understand the former, not the latter, even though the latter is really important. So always try to explain what is the user value that I get out of doing this, because people's gut reaction otherwise would be to not accept it if you're talking about permissions. And then in terms of forwarding voicemails, I think you have to figure out a way that you can do this in an automatic fashion so that people don't manually have to forward voicemails, because that seems both like you have to remind me of this fact all the time, and that you have to, it's a kind of cumbersome thing to do.
Yeah, and your point, Gustaf, about putting a face behind the name when you want to establish trust, and this applies to everybody listening, regardless of what you're selling. This is actually why on demandcurve.com, we took the time and money to record a video where my co-founders, Asher and Justin, and one of our key customers go on record, put their face on video, and talk about the program. And this came out of our concern that most online courses are kind of weird and scammy, and like, why would I want to, like, when we started Demand Curve, we're like, I don't even know if we would pay for online courses. So how do we get through the stubbornness that we would have for our own product? And so we found two ways of doing this. One was the video really helped. It shows that we're not spammy, that we are articulate, that we're thoughtful, we're not some randoms. And the other thing is, and we also put a, like I said, a big customer in there as a talking head. The other thing is we give people a sample of what we're doing, a non-committal sample. They'll get the first day teaser of our program. They'll see it's very high quality for themselves and trust that the rest of the content is equally high quality. All right, so Ashish asks a great question, which I also would love to hear your thoughts on, Gustaf. He says, or perhaps she says, I have a B2B startup with a small set of highly valuable prospective customers. For example, just 20 banks across the country. How would you approach this? For example, should I be prioritizing in-person sales pitches, and how should I maximize my close rates? And we could talk about it a bit broader if we want, Gustaf. Like generally speaking, if you have a very small amount of high value prospective customers, how does that change your strategy if you were otherwise targeting hundreds of thousands of small businesses?
So I asked this question in the YC presentation for YC companies. I asked, can you make a list of your prospective customers? And it doesn't matter if that list is 20 companies or 200,000 companies, but if you can make a list and that list is exhaustive or pretty much exhaustive, you should start by making that list and go after only those companies when you're trying to do sales, and not trying to do too much marketing and sort of like go too wide, because the chances of you hitting the wrong sort of audience is very high. So if you only have 20, that's the best example, but like pretty much everything you should do is going to be sales. Like all you need to do is figure out how is decisions made at these companies, who's the decision makers for the product that I'm trying to sell. Often the important question that people misunderstand is, who is the early adopter inside this organization? Like, it's not the case that most people want to try new things. Most people that work at most jobs are very happy just doing their jobs and don't want to try new products. However, every 10th person at every company is extremely excited about trying new things, and is that person that drives sort of like the adoption forward of that company. Your job is trying to identify who that person is, so that if there's a bottom-up strategy of some kind to make sure you find that person, make sure that you get that person excited about your product. If you can't do that, then all you need to do is just consistent long-term enterprise sales, and that takes a long time. One way to think about sales is sort of like what we call sales economics, which is how much does it cost to sell to a company. And for enterprise sales, we're talking about hundreds of thousands of dollars per contract per year per customer, sometimes more. That means you probably have lots of money and lots of time to spend per customer, which means you're not really going to do an online demo. You're going to go to them and show them what it is, and you're going to be available all the time. And it's just like a different type of dedication than most other sales for B2B would be. That's my simple answer. And so summarize: find the person that's the decision maker, find the person that's the early adopter. Excuse me, but be ready to spend a lot of time with the customer and expecting it to take a long time.
I'd also personally be skeptical of building that type of business. I would first, in my own life and career, try to find businesses that aren't so, determined. The success is so determined on just such a few individuals. Yeah. But in those instances, what I might do is actually make sure I design the company for success networking wise, meaning I would want my co-founder to be someone who already knows all these people, right? I don't want to give up a bunch of equity and have a real relationship with someone who already has these people in their Rolodex. It should be a core competency of your org that you actually know the right people, So I've got a question here from Yakov. He asks, what are we seeing, Gustaf, work for e-commerce companies in terms of customer acquisition channels?
Good question. I mean, depends. But here's the case where I think there's two different strategies here. One of them is you trying to acquire a sale, and one of them is you're trying to acquire a customer. I always think of this as like, you should try to be Amazon, which is mean you're trying to acquire a customer who's going to come directly to you in the future. And you want to figure out how that person comes directly to you in the future. So let me tell you, like, Airbnb is sort of e-commerce. So let's talk about Airbnb, for example. And let's contrast Airbnb to Booking.com. Booking.com, in my opinion, is very transactional, and Airbnb is very much customer oriented. The difference here is that once you've booked an Airbnb the first time, Airbnb is actively pushing you to prompt to download the app. The reason for that is that we want you to go back to Airbnb next time that you are doing a search for homes. You want to go straight to the Airbnb app or straight to the Airbnb website. People tend to, when they go to the website, use navigational search queries, so they would go to Google. But it's better if you go back to the app. What we've seen over time at Airbnb is that more and more people, for every consecutive booking, are coming back to the Airbnb app. So they're coming straight to us for continuous transactions. This is different than something like Booking.com that is primarily relying on Google for first time and even second and third and fourth time orders. Like they're paying Google multiple times. The difference there is sort of like, and I would argue that Airbnb is very similar to Amazon in that in Amazon's case, you go straight back to Amazon's when you do a retail search these days. You don't search on Google first, you search directly on Amazon, either on the app or on the website. That's where you want to be as an e-commerce company, is that you want to build either the sort of like the mind share or some way where people can come back straight to you. Another way of doing that is just through subscription, where you don't even have to think when you're buying the second time. But the difference here is that if you only focus on transaction, then you end up in this sort of like almost arbitrage business where it's just hard to build long-term margins as an e-commerce company, and it's better for you to build something where you have sort of like a recurring transaction. That's why people are underestimating the value of apps, because apps tend to be, and I think Yelp is another great example of that. Apps is becoming the search engine, or the tool that you bring up when you want to look up something a second time. So I really emphasize that. Besides that, I mean, most D2C e-commerce companies are relying on Facebook and Instagram today. That's for most of the growth, and it's depends on sort of like what your model is like and how frequent that purchase is. If your purchase is sort of frequent, then it's fine to acquire someone over multiple months of payback period. If it's a rare occurrence, then the safest thing to do is you only focus on that first transaction in order to get the money back, which means you have to be a high value. The other channels that are still sort of like exist is SEO and SEM. They are quite different than Facebook, and it's much harder to introduce a new product through SEM. SEO takes a long time, and through SEM there has to be like the dynamic on SEM is much more around having a high LTV and being able to win that first transaction over your competitors. So it's just a little bit harder to break into SEM. And by SEM, I mean search engine marketing. So most of the companies are focusing on Facebook and Instagram for the first purchase. But to me, the most important question here is think about the big strategy. I would be unexcited about funding a company in YC who would have to reacquire a customer for every single order. It doesn't matter how good the product is or how good your marketing is. If you have to give away a percentage of your revenue to Facebook every single time that someone is buying from you, that's fundamentally not going to be a good business, and you're going to have tricky sort of like building long-term value. And you want to have a strategy with how you acquire the customers. That customer comes back to you afterwards.
It's hard to overstate how important what Gustaf just said is. It's the sort of thing you realize after your company's failed very often, which is when thinking about acquiring customers, and perhaps particularly for e-commerce businesses, but really for every type of business. Transactional is one thing, but you can also think of acquiring customers from a relationship building standpoint. What's their journey throughout the whole org? And then how do you maximize LTV and retention and all those important metrics beyond just how do I get the next marginal sale through my Facebook ads? But I do want to specifically give you a few patterns that I've seen. So I forget who asked the question, but I just want to give you some quick answers here. I've seen for e-commerce companies, I've seen Instagram ads, sponsoring influencers on Instagram, content marketing / SEO, referrals, Facebook mobile ads sometimes, and Pinterest ads, and Google Shopping ads. Those are the things I see most frequently work for scaling up paid acquisition or just acquisition in general. But I wouldn't even necessarily start there. I would start with the fundamentals, which we can get to in a moment. I want to switch to Nicola's question. He says, or she says, Gustaf, first time hearing you live, so this is exciting. My question is, we have 11 months of runway left, and we're drastically changing our product right now. Think of it as something like Heap and Amplitude. I'm afraid because our current key driver of signups is organic, that 11 months is not enough time for us to speed up organic because it kind of happens organically. So how would you approach this problem we're in? Would you start testing new channels, and which ones might provide quick results?
That's a big question. If you So if, I don't know the situation of this company specifically, but like let's say you have a scenario of I have 11 months runway left. What you're trying to do is you're trying to prove something for there's only two outcomes there. There's three outcomes. One is you run out of money. Two, you raise more money from existing investors or other investors. Or three, you go profitable. So assuming that the first one isn't a good option, if you're trying to raise more money, which is like probably the most likely outcome, you need to think through what are the milestones I need to get to with this 11 months runway. The milestone doesn't necessarily have to be I'm trying to get profitable. The milestone has to be that I'm trying to prove something about the business that allows the people that would invest more money in the business to know that this could scale. So a good example there might be, I'm trying to prove retention of my first 500 or 200 customers, or I'm trying to prove an acquisition channel, or I'm trying to prove just like a new pricing model or whatever it might be. I'm trying to prove something. So making it clear to yourself, what are you trying to prove? And even talking to those investors that you have today to get on the same page of like, what are their expectations or what are you trying to prove? That is probably what I would start. Second to that, like there's a bunch of different things there. One that you want to look at are the people that I'm acquiring consistently using the product? Do I have strong retention? If so, like how much am I charging them? Am I charging too low? It's, in my experience, 20 times more likely that you're charging too little than too much. So one way to find more revenue and to figure out, open up more growth channels is to charge more money. So one of the first experiments for someone who has strong retention and have not run pricing experiments in the past is to figure out a way to charge more money for new users. But just do it. And very, very often YC companies will do this and be like, oh, I tripled my revenue because I charge more, and almost no one is complaining. Like it doesn't, like even if they're complaining, it's not a big deal. It's when they specifically say I'm churning because of price. That's when it becomes a big deal. But when they're complaining and still paying, it's not a huge deal. And then after that, once you have figured out you can make more money and you have good retention, then you can start to figure out, okay, what would be new ways of growing this product? The product you're describing typically grows through developer communities. And what you want to do is first you want to figure out what is my sort of like big famous customer that will sign up. So you want to find a company that can be a customer of yours that everybody have heard of, that you can quote every single time. So like, I got Slack to be a customer of my analytics product. Now, everybody else who's thinking about whether they should use this or not, they'll be like, well, Slack must be making great decisions on their procurement of new analytics products. So I'm just going to go with whatever they choose. So that's why it's so important to find a customer that everybody have heard of in the early days of building a developer tool software, because developers tend to rely on sort of like other developers for their choices. And then after that, once I've acquired that customer that everybody have heard of, that is what I would now use in all my marketing. And I make sure that I can put that logo on the website and keep reaching out to all the customers that I have. And then developer growth channels use a number of different things. You can think of this as like doing traditional marketing is going to be hard because developers tend to not trust marketing as much as to trust other developers. So you want to figure out a way that you can grow this through other developers. And that has many different ways of doing that. So there's a long-winded answers to that question.
No, it's great. I'm going to answer a quick rapid fire one from Emil because I feel passionate about my answer. Emil says, do you think a content strategy based on trying to get frequent small hits rather than SEO can work in the long term? For example, my current approach is I push out my interview content to Hacker News and subreddits. So my answer there is I would never attempt to build a business based on small hits or hits at all, like PR hits or hitting the top of Hacker News. I would always invest in the long-term ones. They also have compounding returns, whereas you're kind of throwing money you're kind of throwing yourself at a wall each time when you try to get to the top of things. And algorithms can frequently change. Like Product Hunt and has redone their algorithm multiple times. And also a friend of mine, Cortland Allen, who's another YC alum, his basic acquisition strategy for a long time was getting to the top of Hacker News because Hacker News was so receptive. But eventually, Hacker News, for whatever reason, maybe they didn't want to promote these posts as much. They got tired of them, seemed like content marketing, and now he has to start from scratch. and it really can throw your business through a loophole. So it's kind of self-evident. I just wanted to get that out there. All right, next question. Shakar asks, if you have a business for which students make a good customer segment, do we have any cool hacks or anecdotes about how to acquire university or high school students at scale?
You think about that. Well, the first question I always ask is sort of like, are you sure about this? Because they tend to be not as valuable because they don't like to pay for things as other customers. So that's the first question I would ask. And often these businesses are built around some kind of discounting for students, and then they're built on brands wanting to get access to those students. I think the good news about students is that they're a very well-defined group, and their well-defined groups tend to be easy to reach because they either are self-identifying themselves on all kinds of online platforms where you can either run marketing or something else, or they're self-organizing in a way that you can find them in places where it's very clear that they're just students. So that's the good news about students. The bad news about students is that they don't have a lot of money, which means that LTV isn't that high, and they tend to gravitate towards deals or cheaper things. And you don't really want to build a business that are associating yourself with sort of like people that are looking for deals, because they tend to bring out the kind of customers that are not going to be super valuable for you in the long run. Now, that would be like the simplest answer. I think that there's, besides that, nothing specific about students that make them any different to reach through the normal targeting channels than others. I don't have I think I need to know more specifics to be able to answer the questions beyond that.
Yeah, no worries. One thing I've seen is certain ad channels like Snapchat or Facebook let you exclusively narrowly target people who are currently students. That's one way to think about it, is what are the platforms that allow me to narrowly target the demographic I'm going for?
Yeah.
Okay, so Roberto asks, how do you think about retention for a product that people buy once and then don't buy again for maybe a year to 2 years?
Well, there's two ways. You either wait 1 or 2 years, or you look for what are the early indicators of someone repurchasing. And in order to get those early indicators, at least for some users, you have to wait 1 or 2 years. Otherwise, you wouldn't know what the indicators are going to be. And in the case of Airbnb, we saw doing searches, again, being a great indicator of someone booking again. So if you had booked and then you did another search within the next 3 months, then that was a really strong indicator that you would book sometime in the future, versus if you didn't do a search. So you could always kind of do a regression on the people that have purchased something on your product and see what other things did they do between that first and second purchase that would indicate that they would come back and do it again. Those are the two things that I would say. I mean, in terms of retention, you don't really know what the retention is going to be, and you cannot make assumptions about what retention is going to be until you start seeing either of those indicators or the second purchase, because you don't know.
Yeah, that's brilliant. And one thing we toy around with the demand curve, because we in some ways have this problem on some products, is we just make sure we're providing ongoing value in a non-transactional way. This is why we put together these webinars. We have a newsletter. We have a Slack group to talk about marketing. We keep ourselves top of mind. We make sure people know we're here when they need us, and that can usually decrease sort of the lag time between first and second purchase. All right, Gustaf, before we continue, I want to point out we have reached the 8-minute mark. So we have a bunch of great questions left, but there's no pressure here, Gustaf. We can stretch the hour, or we can call it here. How are you feeling?
Let's go until 10 o'clock, so we've got 10 more minutes.
Awesome.
11
Kyle
o'clock.
asked, go ahead, Gustaf. Say it again.
Oh, 11 o'clock, sorry.
Okay, yeah, perfect. Kyle asks, what have you guys seen? Well, let me rephrase the question. Is it a good idea to outsource your B2B lead generation, and any thoughts on lead gen services?
Yes. So in terms of building the list of who I should go after, that's mostly data. That's mostly figuring out good sources of data that I can acquire. And it's mostly about figuring out like the quality of that data. Like, do I have the phone numbers and email addresses for the people I'm trying to reach out to? And that is totally fine to outsource. There's there's a manual way and there's a non-manual way you can do it. So there's this companies that you can buy different level of qualities of list from of customers in your target market, and then you can do it yourself. So the simplest possible way, and this is, people always ask me, it's like, oh, how do I find these people wearing their YC? I'm like, have you tried going on LinkedIn? Have you combined LinkedIn with Hunter and just like find email lists for the first like 500 people that you're trying to get a hold of? And like people are like, oh, I should do that. Yes, like it's actually not that difficult to find customers that you try to look for. If that works, and you need a few hundred people to reach out to before you figure out if that works, then you have a benchmark on how much each 100 of these leads are worth, and then now you can start figuring out how much you're willing to pay to buy thousands of them. But absolutely, you can do this. Now, the thing that you would want to make sure you have a good sense on is the quality of these leads and quality of the emails. If the quality is low, you are going to get spam rated when you send the emails. They're going to bounce. They're going to have all kinds of issues. So you do really want to make sure that you're finding a way to get that high quality leads. Generally, you don't want to buy email lists that are large because they're going to be bad. So I'm not a super expert in this area, but I would say that the people that are really good at it have built a process through which they're acquiring these leads. Yes.
Agreed. And also, when you're buying lead lists and you're doing lead gen in general, it's particularly high leverage to actually make sure your emails are customized to those leads. So if you're just buying a giant list of people, you don't know who they are, you just have their emails, but you kind of know they're in your industry, that's usually not good enough. And so I'll use a tool like clearbit.com. I'll enrich these leads, and I'll try to get as much information as possible so that I can really segment my outbound or personalize my outbound emails. All right, so Nadav asks, I have a live video debate platform and I have a chicken and egg problem I would love your help with. He says, big guests to come on and do video interviews. Will only participate if I have lots of viewers, but I can only get lots of viewers if I have cool big guests. How would you think about solving that chicken and egg problem, Gustaf?
So most of the chicken and egg problems are solved with subsidizing supply. Basically means you are going to have to figure out a way to convince the supply to get on. You can't really subsidize the demand very easily. So most of these marketplaces start with like, how can I get the guest on without having the supply? So let's try an example like Luminary just launched like premium podcast app. And how do they do that? Well, they raise a lot of money to be able to acquire these premium podcasts so that they get exclusive access to these premium podcasts so that they're only on Luminary. Once they have that, they can ask all those podcasters to tell all of their listeners through all of their other channels that I'm now on Luminary. I'm not on Apple Podcast or some other app anymore. I'm on Luminary. And I don't know if this is going to work for them, but this is how I would do it. It's much harder to roll out premium podcast and not having anything that's actually premium. So you got to have to think about first, what is the thing that people perceive as valuable? So in your case, you're going to have to figure out a way to get these really famous interview objects on your show, and then you're going to have to find a way to either reach their audiences directly or offer them to reach their audience through their through their existing audiences. It takes a long time to build up something like a Reddit AMA. Like they are not something that's done fast. But the best hack is to sort of like use the existing audience of the people you're trying to interview.
Agreed. Our mutual friend Radu from Lissel, the YC batchmate of Demand Curve, says, first off, thanks for hosting this. And he wants to know, when should you start investing in paid advertising as a consumer app? What is the threshold?
First of all, you need to make revenue. If you don't make revenue, it's not worth doing anything on paid advertising, really. Once you have revenue, that most of the things you're trying to do is trying to figure out, can the ROI on the money I spend on advertising ever be matched by the revenue I'm making for the people I'm acquiring through that audience? Because the people you're acquiring through paid aren't necessarily going to be worth the same as the people that come through other channels. So what you're trying to prove is basically, are the people I'm acquiring through the paid channel going to be worth as much? And are they going to be worth as much that I'm actually able to pay back the investment in any time window? For startups, we would typically say in YC, 3 to 4 months of payback window is sort of what you've been looking for. Sometimes it's shorter. That would be even better. To have a 12-month or 18 months payback window, it's sort of scary in the sense that like you don't really know if this is going to work. So you're always trying to work towards a shorter payback window. Now that's not easy, and it's not something that most companies have. And until you're there, you don't want to spend too much money on advertising because you want to make sure that payback actually happens. And then the payback window is different depending on what kind of product you have. If you have a subscription product, or if you have a one-time purchase product, or if people are going to come back, then it sort of depends. The truth is that online marketing is one of those channels that actually really works well. So if you figured out how to make it work, then this is important for growth of your company. It's increasingly more important over the last couple of years to be really good at online marketing compared to other channels, because the large platforms that have aggregated our attention, Facebook and Google, are so good at monetizing that attention these days that it's just like you don't really have a choice but to become good at online marketing. But before you get there, is you need to be good at having a product that people want to spend money on, that people want to come back and buy again, and all of those things matter before. And people tend to forget that part. They're more likely to forget that part compared to sort of like just being really good at online marketing. If that makes sense.
All right, Gustaf, thank you so much for your time today, my friend. The comments that have been coming in have been really nice and appreciative of your wisdom. So thank you. A quick note on YC. Consider applying at ycombinator.com. So our company, Demand Curve, went through YC. We got a tremendous amount of value out of it. The partner advisory, like having these chats that we just had with Gustaf and the other partners across multiple disciplines, customer retention, building a team up, choosing the right market, all that stuff we were able to talk to partners about. We also had access to the alumni community, which is like 4,000 alumni, which was incredibly useful. And then the fundraising environment was like the very high leverage financial kicker. So we had a great experience. I recommend it. Gustaf, thank you, sir. Much appreciated. And we'll get this recording online soon.
Thank you all for listening. I'm glad to be here.
Thanks, Gustaf.
Thank you. Bye.
That's it for today's webinar. You can check out demandcurve.com for details on our growth marketing training program and other cool growth related products that we work on. Have a great day.